In these unpredictable times, making the right business moves is more crucial than ever. Join us as we dive into the world of short-term business decisions to help you stay ahead. So in this series, you will be able to master the art of evaluating special pricing orders, learn how to maximize revenue and minimize costs, make informed, strategic choices that drive success even in uncertainties. Equip your business with the strategies it needs to thrive in challenging times. Welcome back to part 2 on short-term business decisions. As a disclaimer, the content of this video is for educational and entertainment purposes only. It should not be considered as professional accounting advice. For personalized guidance, please consult a certified accounting professional. So we begin with learning objective 2, make regular and special pricing decisions. In the past, managers viewed pricing as a long-term decision. However, with product life cycles shrinking across most industries, companies often introduce new products or updates every few months. As a result, pricing decisions now need to be made more frequently than before. Managers need to address 3 key questions when setting regular prices for their products or their services. And the first question is, what is the company's target profit? 2, what price are customers willing to pay? And the third question is the company a price taker or a price setter for their product or service? So the answers to these questions, they are complex and subject to constant change. Shareholders expect the company to meet specific profit targets influenced by factors such as economic conditions, historical performance, industry risk, competition, and new business developments. Now, managers must avoid setting prices higher than what customers are willing to pay, as this would lead to what? A decrease in sales volume. Price taker. A price taker is a company that has limited control over its pricing because its products or services are not unique or because competition is intense. Examples include commodities like milk and corn, natural resources such as oil and lumber, and generic consumer goods and services like paper towels, dry cleaning, and banking. In contrast, a price setter is a company that can control its pricing due to the uniqueness of its products or services and limited competition. Unique items like original artwork, specialized machinery, patented perfumes, and cutting-edge technology can command higher prices. So to gain greater control over pricings, companies often strive to differentiate their products. They aim to make their offerings stand out through unique features, superior service, or enhanced quality, or at least create the perception of uniqueness or superiority. A differentiation is frequently achieved through strategic advertising. Here in Exhibit 2, it summarizes the differences or the difference between price takers and price setters. A company's approach to pricing depends on whether it is on the price taking or price setting side of the spectrum. Price takers emphasize a target pricing approach. Price setters emphasize a cost plus pricing approach. So you want to keep in mind that most companies provide many products and services. A company may be a price taker for some products, and they may be a price setter for other products. When a company is a price taker, it uses a target pricing approach to manage costs and profits. The basic profit calculation is revenues minus cost equal profits. So if we adjust this equation, we get the target pricing formula, which is revenue at market price minus desired profit will equal your target full product cost. Now, this formula starts with the market price, which is the price customers are willing to pay, and then subtracts the desired profit to determine the maximum allowable target full product cost, covering the development, the production, and delivery of the product or service. Target pricing is often referred to as target costing because the desired target cost is derived from the target price. Again, target pricing is often referred to as target costing because the desired target cost is derived from the target price. Now, this approach manages costs and profits by determining the target full product cost, which includes all expenses related to developing, producing, and delivering the product or service. So in this context, the sales price is set by the market, representing the maximum amount customers are willing to pay. The company has no control over this market set price, and they must focus on controlling costs to achieve their desired profit. So let's return to Smart Touch Learning. We know that Smart Touch Learning is a fictitious company that manufactures tablet computers. Okay, so let's assume that tablet computers sold by Smart Touch Learning, they are a commodity, and that the current market price is $500 per tablet. Here you see in this Exhibit 3, it shows the expected operating income for the company for 2026 for 24 tablets. You have the net sales revenue at 1.2 million. Variable costs, you have manufacturing at 588, selling and administrative at 150, which is a total of $738,000. So when you subtract the variable cost from the net sales revenue, you get the $462,000. Then you have the fixed cost, which involves manufacturing and selling and administrative, which is a total of $226,000. So the expected operating income is or will be $236,000. Now, since the tablets are a commodity, Smart Touch Learning will use a target pricing approach. Assuming that the company stockholders expect a 10% annual return on the company's assets, and with $2.5 million in average assets, the desired profit is $250,000. That's the 2.5 million times the 10% that the stockholders expect on an annual return of the assets. So once the target full product cost is determined, we can analyze the fixed and variable cost components separately. Now the question is whether Smart Touch Learning can produce and sell 2,400 tablets at a total product cost of $950,000. To find the target full product cost at the current sales volume of 2,400 tablets, we calculate revenue by multiplying 2,400 tablets by the selling price of $500 per tablet. This revenue figure is also shown in the income statement that you see here. Actually, the revenue figure is also shown in the income statement that you'll see in the later chapter. Subtracting the desired profit from this revenue gives us the target full product cost. When setting regular sales prices, companies ensure they cover all costs, whether product or period, fixed or variable. So in the case of Smart Touch Learning, we see from their contribution margin income statement, we see that the company's total costs are $964,000, which is $14,000 more than the target full product cost of $950,000. So what can Smart Touch Learning do in this situation? Well, one option is to accept, they can accept a lower operating income of $236,000. However, this represents a 9.44% return, which falls short of the 10% target return expected by the stockholders. Two other options are to reduce either fixed costs or variable costs by $14,000 or more. A fourth option is to try to increase sales volume. If the company has excess manufacturing capacity, producing and selling more units would only impact variable costs. Now, this would spread the current fixed cost over more units, reducing the total cost per unit and also increasing profits. Also, Smart Touch Learning could consider changing or adding to its product mix, which is a topic that we'll discuss later in the chapter. A sixth option for the company is to try to differentiate its tablet's computer from the competition, thereby gaining more control over its sales prices and becoming a price setter. Finally, the company could implement a combination of the above strategies to increase revenues and or decrease costs by $14,000. When a company is a price setter, it uses a cost-plus approach to pricing. Now, this method is essentially the opposite of the target pricing approach. In cost-plus pricing, the company starts with its full product costs and adds it to its desired profit to determine the cost plus price. Essentially, this rearranges the basic profit calculation to solve for the revenue figure, which becomes the price. When a product is unique, the company has more control over its pricing. However, the company must ensure that the cost plus price is not higher than what customers are willing to pay. So let us revisit Smart Touch learning example. Let's assume that the tablet computers have brand recognition due to the company's preloaded e-learning software, giving the company some pricing power, right? So using a cost plus pricing approach based on the current sales level and a desired profit of 10% of average assets, the cost plus price is calculated to be $506 as shown in this slide. The full product cost is determined by adding variable costs to fixed costs. Then the desired profit is added. The desired profit is the return on investment of 10% multiplied by the company's average operating assets. So the target revenue of $1,214,000 is divided. You would divide that by the 2,400 tablets, which would result in a price of $506 per tablet or per unit. In pricing decisions, all cost information is relevant. It is relevant because the company must cover all costs along the value chain before generating a profit. However, it is important to consider variable and fixed costs separately due to their different behaviors at varying volumes. To optimize pricing decisions, the rule is if the company is a price taker for the product, it should use a target pricing approach. If the company is a price setter, it should use a cost plus pricing approach. A special pricing decision arises when a customer requests a one-time order at a reduced sales price. So before agreeing to such a deal, management must consider several factors. What are those factors? One, managers need to assess the available manufacturing capacity. If the company is already operating at full capacity and selling all units at the regular sales price, accepting a special order at a reduced price would not be as profitable. Therefore, having excess capacity is essential for taking on special order. Second, managers must evaluate whether the special reduced sales price is sufficient to cover the differential costs of fulfilling the order. Differential costs are the costs that differ if the special order is accepted. The special order must yield a positive contribution margin to be worthwhile. Additionally, the company must consider fixed costs. If there is excess capacity, fixed costs are likely unaffected by producing more units or delivering additional services. However, there may be situations where additional fixed costs are incurred, such as increased insurance premiums or the need for special equipment to fulfill the special order. And finally, managers must consider the potential long-term impact on regular sales. So will regular customers learn about the special order and demand lower prices? Will the special order customer expect the same reduced price in the future? So these are questions that managers are faced with when it comes to special pricing. Suppose Smart Touch Learning expects to make and sell 2,400 tablets before considering the special order. Here you see in Exhibit 8.4, Smart Touch Learning's budget and income statement, traditional and contribution margin formats. On the left is the traditional format, and on the right is the contribution margin format. The traditional format income statement shows a product cost of $290.83, which is that $698,000 COG. If you divide that by the 2,400 tablets, you'll get the $290.83. So a manager who does not examine these numbers carefully, they may believe that Smart Touch Learning should not accept a special order at a sales price of $275 because each tablet costs $290.83 to manufacture. But appearances can be deceiving. Recall that the manufacturing cost per unit for the tablet is a mixed cost, which contains both fixed and variable cost components. So to correctly answer the question, we need to find only the variable portion of the manufacturing unit cost. Using a differential analysis approach, Smart Touch Learning evaluates whether the special order will be profitable by comparing the additional revenue it generates with the additional costs it incurs. Now, these costs and revenues are the ones that will change if the special order is accepted. Here you see in Exhibit 5, the special order will raise revenue by $68,750. That's 250 tablets at $275 each. But it will also increase variable manufacturing costs by $61,250, which is 250 tablets at $245 each. Consequently, the contribution margin will increase by $7,500, as previously detailed. Now, other costs in the Exhibit 8.4 that you saw earlier are not relevant to this decision. Variable selling and administrative expenses will remain unchanged since no special efforts were made to secure the sale. Fixed manufacturing costs will not be impacted because Smart Touch Learning has sufficient idle capacity to produce the 250 additional tablets without requiring more facilities. Similarly, fixed selling and administrative expenses will remain unaffected by the special order. With no additional fixed costs, the entire increase in contribution margin will directly boost operating income. Thus, the special order will increase operating income by $7,500. This analysis adheres to the principles for making short-term business decisions, whereas you're focusing on relevant data, which are changes in revenues and costs, and using a combination margin approach to differentiate between variable and fixed costs. In summary, the decision rule for a special pricing order is accept the special pricing order if the anticipated increase in revenue is greater than the anticipated increase in both variable and fixed costs. You would reject it if the expected increase is less than the anticipated or expected increase in both variable and fixed costs. Again, the decision rule, whether to accept or reject. If the expected increase in revenues exceeds the expected increase in variable and fixed costs, you would accept the special pricing order. However, you would reject it if the expected increase in revenue is less than the expected increase in variable and fixed costs. Okay, so as we conclude part 2 on short-term business decisions, we have explored the essential principles for evaluating special pricing orders, focusing on how to assess changes in revenue and cost to determine profitability. With a clear understanding of these concepts, you are now equipped to make informed decisions that can enhance your business financial performance. This is the end of part 2. In part 3, we will look into another crucial aspect of short-term decision making, which is managing your product portfolio and sales strategy. So our next learning objective will focus on making strategic decisions about dropping a product, optimizing your product mix, and evaluating your sales mix. So stay tuned for part 3 as we uncover these key strategies to drive your business's success. Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.